Picking the right ETF can feel overwhelming, especially if you're just starting to invest. There are literally thousands of ETFs out there, so which do you choose? That's where many people get stuck, but waiting can cost you thousands of dollars in compounding growth. Now here's what I wish someone had told me. There's one type of ETF that basically builds your entire portfolio for you. It's called an all-in-one ETF. It's globally diversified and automatically rebalanced. So today I'm going to walk you through what this all-in-one ETF is all about and also list my top 5 choices for you to consider. So what makes an all-in-one ETF different from a regular ETF? And why can this be a great solution, especially for beginners? As most of you know, an ETF, short for exchange traded fund, is basically a basket of investments. For example, if you wanted to invest in stocks, instead of having to decide how many Apple stock you want to buy, how much in Nvidia, Google, etc., you just buy the VFV or the VOO and you are automatically invested into 500 of the largest US companies. Now, most of you watching this already know this, but here's the real problem. Although you know that ETFs are the way to go, you still have to choose which ones you want specifically. And that's where it can get overwhelming fast. For example, the VFV tracks the S&P 500. Great fun, but it only includes the biggest US companies and only holds equities. If you wanted some international exposure or emerging markets exposure, you're looking at a separate international ETF, for example, the XEC. Then you think you might want to have some bonds for stability when the market drops, so now you're adding a bond ETF on top of that. And perhaps you even want an ETF to cover the Canadian market. So now you not only need to decide which specific 3, 4, or even 5 ETFs to pick, but you also need to watch out for possible overlaps in holdings. And as the market shifts, the value of your holdings shift as well, so you have to go back in and rebalance those funds manually so your allocations don't drift out of whack. Now that's where all-in-one ETFs come in. In short, all-in-one ETFs are a basket of ETFs. So by buying an all-in-one ETF under one ticker, you are instantly invested in several ETFs that can each hold US stocks, international stocks, bonds, and so on. Everything is bundled together inside one fund and gives you a target asset allocation. For example, 40% in bonds and 60% in stocks, or 30% in bonds and 70% in stocks, and so on. The awesome thing is that all-in-one ETFs also rebalance themselves automatically. Over time, the assets inside your ETFs grow at different rates, throwing off your intended mix. You'd normally need to rebalance manually, meaning buying and selling ETFs to restore your original intended mix. An all-in-one ETF does this automatically for you, so it saves you some work. And here's something important to consider that will make your investment decision easier. You are not locked in when you buy an all-in-one ETF. What I mean is that if you're just starting to invest, you can start with an all-in-one ETF, but then later on, when your knowledge and your confidence grows, you can always change your mind, sell off some investments, and then reallocate into more specific ETFs or even stocks. And there are 2 important tips that I want to share with you so that you have maximum flexibility in your investment journey. 1, to minimize tax consequences, ideally buy investments within your TFSA or RSP first, as within those accounts your investment gains are not taxed. 2, buy these all-in-one ETFs on investment platforms that don't charge trading fees. Many traditional banks and brokers still charge fees for buying and selling ETFs, and you don't want that. It doesn't really matter which platform you choose, but just make sure it's a reputable company and does not charge fees for trading. I invest on several, including on Wealthsimple, because there are no trading fees for buying and selling ETFs. More details later, but in case you want to check out Wealthsimple, there's a link down below for a $25 bonus. Note guys, the below are affiliate links, and if you use them to open an account, I may earn a small commission at no additional cost to you. So guys, I did the research on all-in-one ETFs for you, and I'm going to share with you my top 5 picks. By the way, all the ETFs I'll mention are listed on the Toronto Stock Exchange and priced in Canadian dollars. So in Canada, there are 3 main providers of all-in-one ETFs, which are Vanguard, iShares, which is owned by BlackRock, and BMO. Then there's also Horizon, rebranded to Global X, that is smaller than the other companies. Each provider has a series of all-in-one ETFs for different risk levels, differing mostly in their bond to equity ratio, starting from conservative to all equity. I used 4 criteria to pick my all-in-one ETFs. My first criteria is the holdings within the ETF. How well diversified, especially geographically, is the ETF? Second, what is the ETF's yield? Third, how did it perform historically? And lastly, how expensive or cheap is the MER, or the management expense ratio? But before we dive deeper, I want to let you know that when I say my ETF pick, this just means that I chose an ETF based on my own criteria and my personal financial goals that apply to me. I am not sponsored or compensated in any way by any of these ETF issuers. Everything in this video are my personal opinions only. I'm not an expert, but just a regular investor myself. The purpose of this video is just to walk you through my personal thought process. I'm not telling you to buy any of these ETFs, so before you make any financial decisions, make sure that you consider your personal goals, financial situation, and risk tolerance. I'm not a financial advisor and I don't give out any financial advice, so make sure you consult a professional financial advisor if you need any help. So now let's start with my first pick. Now let's start with the conservative option. My top pick is the VCNS, or the Vanguard Conservative ETF Portfolio. The VCNS is the conservative tier option from Vanguard. It trades on the Toronto Stock Exchange at around $32 per unit as per making of this video. Let's start with what I care most about for an all-in-one ETF, which is holdings and diversification. VCNS holds roughly 40% in equities or stocks and 60% in bonds. Note that all-in-one ETFs come in different versions based on their risk level. The main thing that changes between them is the bond to equity ratio. More bonds means more stability and more modest growth. More stocks or equities means more growth potential, but more short-term up and downs as well. So this ETF is more on the conservative side, as it has a considerably higher portion in bonds at 60% and 40% in equities. Now here's what the geographic allocation looks like. About 43% in US investments, 31% in Canadian investments, so North America alone makes up around 74% of the mix. Then there are some developed international markets like Japan, the UK, and some emerging markets like China and India. The VCNS also has a good bond mix. It actually includes exposure to international bonds, not just Canadian or US bonds. Now looking at the yield. Yield is basically the income the ETF pays out to you expressed as a percentage of its price. I'm specifically looking at the trailing yield here, which is about 2.5% at the moment and paid out quarterly. Performance-wise, the VCNS had an average annual return of 5.2% since its inception in 2018. It's obviously not as high as the performance of, let's say, a pure S&P 500 ETF like the VFV or VOO, but that's part of the package, as you have a higher percentage of bonds in the mix. The upside is that with this kind of mix, you'll have a bit less price fluctuations. And that's why the VCNS is suitable for people with a low risk tolerance who prefer less volatility. VCNS previously had an MER of around 0.24 to 0.25%. However, effective November 18th, 2025, Vanguard actually reduced the underlying management fee from 0.22% to 0.17%, which will bring the MER down once it's recalculated at year end. This makes Vanguard's fund noticeably more competitive on cost. Now, in case you're not familiar with what the MER is, it is basically a fee for management expenses that's calculated into the fund. It's not a separate fee billed to you, but it does reduce the fund's performance, so you do want to have it as low as possible. At an MER of 0.17%, for example, that works out to $17 per year for every $10,000 you have invested. As it's far below 1% and a small fraction of a percentage even, I wouldn't put too much weight to it. You will probably feel the difference if you have hundreds of millions or billions of dollars invested, but the difference is negligible if you invest in the thousands or hundreds of thousands of dollars. So VCNS is my favorite in this category, but there's another ETF, a contender worth mentioning, which would be my second pick. The other conservative option is XCNS from iShares or BlackRock. This ETF has a comparable structure to VCNS, with 40% in equities and 60% in bonds, so similarly conservative in that sense. If we look at its holdings, the XCNS has almost 55% invested in Canada and 30% in the US, bringing its total North America allocation to 85%. So you see, it is skewed much higher towards North America than VCNS, and more than half even in Canada, and less and much less in other international markets. Personally, in an all-in-one ETF, I prefer less concentration in North America and a higher diversification into international markets. Because the point of buying an all-in-one ETF in the first place is to get global exposure, not just a heavy bet on one or two countries. Here's the thing though, most all-in-one ETFs significantly overweight North America, especially Canada. Yes, you want to invest in Canada, but consider this. Canada represents roughly 3% of the global stock market by size. Yet many all-in-one ETFs allocate anywhere from 20 to to 30% in Canadian investments. That is what's called a home country bias. It's not automatically wrong, but it does work against the diversification goal that you're paying for. So when I'm comparing ETFs at the same risk level, lower North America concentration is a meaningful advantage in my view, and you'll see that consideration throughout my other picks as well. So here I could only find the distribution yield, which is 2.42% at the moment. This is a bit different from the trailing yield. So a quick detour here. While the trailing yield is the historical yield of the past 12 months, so what's actually been paid, the distribution yield is the estimated future yield based on the most recent payment. But if we just take this number, then XCNS's yield of 2.42% is very similar to VCNS's at 2.5%. Its performance since inception was 6%, a bit higher than the VCNS. But again, we're looking at historical performance here, and although this can give us an indication, it doesn't necessarily tell us how it will develop in the future. Next, let's look at XCNS's MER, which is 0.19%. After Vanguard's adjustment of its MER number, I think the MERs will be very similar, and again, if the difference is just 0.01 or 0.02%, then it's negligible. So again, the main reason I pick VCNS over XCNS is simply that VCNS has more international diversification. Now I want to quickly mention the other alternatives. There's Zcon by BMO and also HCon by Horizon, now Global X, but I'm not a fan of either because both are too heavily weighted in North America in my opinion at around 85% each, as you can see here. Zcon or Zcon 52% plus 36%, that's about 88% in North America, and HCon 50% plus 37%, that's about 87% in North America. So if you ask me, that defeats the purpose of having an all-in-one ETF. By the way guys, before I continue, let's briefly talk about where to actually buy these ETFs, because the platform you choose matters more than most beginners realize. Traditional banks and brokers often charge trading fees each time you buy or sell an ETF. That adds up fast and makes the flexibility to switch later, which we talked about, really expensive. So make sure to choose an investment platform that charges no fees for buying and selling ETFs. I trade on several platforms, but one that I use most often and have been happily using for over 5 years is Wealthsimple. Wealthsimple is a Canadian online brokerage I find really easy to use even when I was a beginner. Setup only takes minutes and buying ETFs is commission free. If you decide that Wealthsimple is right for you, you can even get a $25 bonus by using my link or code in the descriptions down below. Important note, if you like to take charge of your own investing and pick your ETFs or all-in-one ETFs or whatever investments you would like to make, including when you buy or sell, then make sure that you open a self-directed trading account and not the managed portfolio. And again, while I'm not sponsored, the below is an affiliate link, and if you use it to sign up for Wealthsimple and open an account with them, then I may earn a small commission at no additional cost to you. Now let's continue. So let's move up a level on risk. My next pick for the balanced risk category is the VBAL, Vanguard Balanced ETF Portfolio. Quite easy to remember, V stands for Vanguard as these ETFs are coded, and BAL for balanced. Balance simply means that you're taking on a bit more risk compared to the conservative option, and that reflects in a higher portion of equities. Whereas previously we had only about 40% in equities, balanced all-in-one ETFs are usually around 60% in equities and 40% in bonds, so flipped. Naturally, this may result in more growth potential, but also more fluctuations. VBAL is the balanced option from Vanguard. It currently trades at around $38. Now, holdings and diversification first. VBAL holds approximately 60% in equities or stocks and 40% in bonds, so typical of an all-in-one ETF in the balanced category. Geographically, the market allocation is about 43% in the US and 31% in Canada, bringing the North America allocation to roughly 74% again, similar to the VCNS. You also get a diversified bond allocation, with 23% in Canadian bonds, almost 8% in US bonds, and almost 8% in international non-US bonds. The trailing yield on VBAL is around 2.2% at the moment, paid quarterly. On performance, VBAL has averaged a bit over 7% annually since inception in 2018. In 2025 specifically, it returned around 13%, which is solid for a balanced fund. Going on to the MER, which was 0.24%. But again, effective November 18, 2025, Vanguard reduced the management fee for this ETF from 0.22 to 0.17%. The MER does not yet reflect this fee cut as it is calculated at the fund's fiscal year end. So possibly the MER will be around 0.19 or 0.20%, which makes it competitive with other similar ETFs in this category. As an option, I'd say that the main competitor here is XBAL from iShares by BlackRock. Its yield is currently at 1.81%. Again, I could only find the distribution yield, but considering that the distribution yield quoted is usually a bit more optimistic than the trailing yield, we could say that XBAL's yield is probably a bit lower than VBAL's. So the reason why I prefer VBAL over XBAL is again geographic distribution. XBAL is 44% in Canada, that's almost half, and almost 35% in the US, bringing its North America share to 79%. Remember, VBAL had a total allocation of 74% in North America, still huge if you ask me, but better in my opinion. VBAL still carries slightly more geographic breadth with emerging market exposure. The MER difference between VBAL and XBAL I think is genuinely small. We're only talking a few dollars difference a year on a typical beginner account. I still prefer VBAL for those reasons I mentioned before, but you would not go wrong with XBAL either. Now before we go on to my next pick for growth ETFs, if you find this kind of content useful, the subscribe button is right there. It genuinely helps my channel grow and it means that I can keep making these videos, so thank you. My personal pick for growth all-in-one ETFs is the VGRO. The VGRO is the growth option from Vanguard, and it currently trades at around $45 as per making of this video. Let's talk about holdings first. VGRO is approximately 80% in equities and 20% in bonds, which is typical of all-in-one growth ETFs. This gives us much larger growth opportunity as the name says and potential upside, but also has higher risk. The 20% bond slice is there to take the edge off volatility without dramatically pulling down long-term growth. Personally, I am very comfortable with this level of risk based on my personal situation. I'm fully aware that there is a risk, but I also truly believe in the saying, no risk, no gain. But that's just me. You will need to figure that out based on your age, financial situation, responsibilities, goals, risk tolerance, and so on. Now again, looking at the international diversification, this Vanguard product is about 74% allocated in North American markets, that's Canada and the US. The trailing yield, so the yield that's calculated based on what has historically been paid out, is 1.87%, a bit lower than the balanced fund because equities make up a bigger share. On the performance side, VGRO has averaged around 9% annually since inception, and in 2024 and 2025 it returned about 20% and 17% respectively, which is quite high. But again, we can't determine future performance based on past performance. Also, the MER was 0.24%, but again, Vanguard is lowering that significantly. So I also looked at XGRO, which is a popular competitor to VGRO. XGRO is issued by iShares, BlackRock, and the XGRO had a lower performance of 6% since inception. And the distribution yield was 1.29%, a bit lower than VGRO's. I hate repeating myself, but again, my main reason for preferring VGRO over XGRO is VGRO's smaller tilt towards US and North America. But of course, we could look at this the other way. If you'd actually prefer a higher allocation in Canada and the US, then XGRO is the way to go for you. If that's your preference, you could even go with BMO's ZGRO. Also 80% in stocks and 20% in bonds, but more heavily weighted in North American ETFs, with 44% in the US and almost 34% allocated to Canada. So as you can see, it's a really fine difference between these ETFs. As long as you stick to the right risk category, as in how much stocks versus bonds you want to have, I don't think that you can go totally wrong. At that point, it is more a matter of optimization. So VGRO, that's just what I would pick. Quick questions for the comments. Which risk level do you think fits where you are right now? Conservative, balanced, growth, or even all equity? Drop it below, I read every comment. Now moving on to my final pick, and that is the all equity tier, which is actually my favorite category to talk about. In this category, we usually have 100% in equities and no bonds. My favorite here is not from Vanguard, surprisingly, but from iShares BlackRock's XEQT. The XEQT practically holds 100% equities, apart from point-something% in cash. So no bonds. It currently trades at around $42 per unit right now. Let's look at holdings and diversification. XEQT is heavily invested in North America again, but surprisingly at a much lower percentage. We have about 43% in the United States and only about 25% in Canada. Granted, the US portion is highly overweighted, but still it brings the North American portion to just about 68%. The rest is in a mix of developed markets like Japan, quite high at 6%, the UK, a lot of European countries, and also emerging markets like China. Let's briefly compare that to my runner-up choice, which is the VEQT. The VEQT is also 100% in equities, but it retains the same North America allocation as with Vanguard's other ETFs of 74% in total. This is the main reason why I choose XEQT over VEQT. I think the XEQT as an all-in-one ETF is better diversified internationally. If you look at VEQT's country allocation, you'll only see tiny percentages in international markets. There is much more international diversification with the XEQT. Talking about yields, VEQT does have a slight upper hand. XEQT's distribution yield is only about 0.87% at the moment of making this video, while VEQT's trailing yield is 1.41%. I don't think that this is a main consideration though, especially since these are growth funds. People are usually not looking for a high yield here. If we look at performance, it's pretty similar for XEQT and VEQT at an annual average of about 13% since inception. Both really solid. Again, past performance is not a guarantee. These are backward-looking numbers, but they do give you useful context. The MERs are also very similar for both. So again, the main consideration here would be what kind or what level of international diversification you want to have. Do you want a higher weighting for North America, US, Canada? But it's worth thinking about the future and the current macroeconomic and political developments. Do you believe this trend will continue, or will growth shift to the rest of the world? In case you believe the latter, then perhaps XEQT is the better choice. Again, not financial advice, just thinking out loud. But I'd love to hear what you think in the comments down below. So which should you pick among all these 5? After all, the point of an all-in-one ETF is to choose one and then leave it. The idea is not to pick a combination of these, because then you'll have overlaps of the same companies and it can get hard to keep track. So this is what I think. I think that you really need to choose based on the level of risk that you are comfortable with. If you want lower risk, you choose the conservative option. The higher risk you can deal with, the more you go in the direction of growth or all equity. Personally, I am prepared taking on more risk, so my top of the top pick would be the XEQT. This is just me, but I don't really want bonds in my portfolio. Since I'm still young and have a stable income, I can afford more risk. Even if my portfolio were to crash by 30%, I'm prepared for that. I still have enough emergency cash to weather it and enough income and time to rebuild it. So you have to ask yourself, is that the case for you too? If you have tons of financial responsibilities and your income is shaky and you don't have a lot in emergency cash, plus you're near retirement age, then reconsider if something more balanced or even conservative is better for you. Now here's another really important question. After all of this, should you really buy all-in-one ETFs? And what options do you have? The other option to buying all-in-one ETFs would be to just build your own ETF portfolio. Buy a Canadian ETF, a US ETF, an international ETF, and a bond ETF if you want to. Then rebalance occasionally so you stay within your target allocation. The advantage of doing this is that, for one, you get to choose exactly the individual ETF that you want. Also, it does result in a slightly lower overall MER than an all-in-one ETF. But again, the downside to this is overthinking it, procrastinating, and more work. If that's not for you, then going the all-in-one ETF route is probably better. The MER is a bit higher, yes, but it still makes sense. So if you're a beginner and you want to keep it easy, then you could start with an all-in-one ETF that fits your risk level. Not financial advice, just my opinion. And as I said in the beginning of this video, you're not locked in. As your knowledge and confidence grows, you can sell parts of your ETF and then buy individual ETFs to build your tailored portfolio. The important thing is really just to get started and not delay it. Now, if you've decided which all-in-one ETF fits your risk level, the next natural question is where to hold it, TFSA or RSP first, and how to think about that decision. I made a full video on exactly that, so you can join me in this one later.